market. This gentleman has been involved with the equity markets for nearly 19 years and has seen several cycles like these. Nitin Jain, the principal investment manager at Kotak UK, joins us now to talk about how he is wading through these turbulent times. Nitin, hi, good morning and good to speak with you. The consensus opinion at a time like this seems to be to buy into this panic and not worry about the global upheavals too much. Is that your view as well? Is this the time to put in incremental money, or do you think that one will get better opportunities in the weeks to come?
Morning. It's very difficult to call the bottom. In fact, it will be futile to call this as the bottom of the market. We have very strong flows which can swing the market either ways. But it's a good time to buy. We've been bullish in the market for the last 6 months now. For the last 1 year, we have had good gains. But in the last 6 months, all those gains have evaporated. So with the market coming down, we are more bullish on the outlook. So it's a good time to buy in the market. But to say that this is the bottom of the market, maybe not. Maybe we can have a little bit more volatility in the short term. But it's definitely a very good time to accumulate stocks.
Good morning, Nitin. Thank you very much for dropping by in our studios. This is a slightly larger question, I think, that Sonia is pointing to. Is the market kind of breaking down? Is it giving you the sense? Raghuram Rajan was speaking to BBC and he said that he can't compare it to, he doesn't see the signs of comparing it to the Asian financial crisis, and certainly you wouldn't compare it perhaps to the Lehman crisis. But there are a lot of people who think that this is a trailer for a rather large meltdown. What chances would you give a large meltdown globally in all risk assets?
So clearly the jury is still out on that larger global meltdown. The big difference this time around is the players in 2013 who were on the downside were very different than the players today. The oil being the big differentiator. And so if I look back in 2013, we were among the fragile 3, fragile 5, whichever club we could be put in, we were there. And today the equation is completely reversed. So I think from India's perspective, things are definitely looking much better. And I think it's always better to recap the big triggers of the market since 2013. First is monetary prudence with Raghuram Rajan coming in, then political ability, and third is oil. And all three are meaningful triggers and are staying with us. On the last point, the oil, and I think there is something which is, from India perspective, which is quite meaningful at this point of time. What we were feeling and what we were thinking when oil was coming down to around $65–70 of barrel initially was this benefit may be temporary and the benefit may actually evaporate soon. Oil may move back. Today, with oil being at 40, the benefit is significantly larger. And even if oil were to move back, it doesn't look like it will move back very sharply up from $60–70 a barrel. So in many ways, it has become a semi-permanent or a permanent gain for Indian consumers. And all of that will reflect in consumption behavior, in government budgets going forward and in current times. So I think from that perspective, it's a very different ball game. So yes, on global meltdown, we don't know. China is such a big equation in this entire equation. And there are so many countries which are facing serious trouble on their fiscal maths because of oil prices and other commodities coming down. So on global front, it is difficult to call whether this is a trailer or whether this is possibly the bottoming out. But from an India perspective, India does stand out at this point of time.
Okay, so India stands out at this point of time. I was just going through your Kotak Mahindra UK small cap fund, and you have some great wealth creators in this fund. Names like Britannia, Divi's Laboratories, Motherson Sumi, Bajaj Finance have given very good returns. But what do you do at a time like this? Do you continue to hold on to these quality names despite valuations, or now would it be more prudent to churn your portfolio?
So first, let me correct you. It's not a small cap fund. It is a mid-cap bias fund. Okay. Yes, many of the names that you talked about have delivered very strong returns, and we believe will continue to deliver returns in times to come by. So one, we clearly believe that the PE multiple re-rating of the entire mid-cap segment is possibly done with at this point of time, and now earnings will start catching up. But on the other side, when you look at flows, the domestic investment flows are so strong at this point of time. And the typical behavior of the domestic investor, which has been now discussed very in the public domain, that they would be buyers of mid-cap more than large cap, and they're more bottom-up in approach. I think the flows will determine to a large extent the bottom of the mid-cap PE multiple. And they can, so the PE multiple re-rating might be over, but they can continue to get support from domestic flows. And incidentally, for the year as a whole, now domestic flows are now larger than foreign flows, and which is a big shift in the way the mid-cap versus large-cap can behave on an ongoing basis. Clearly, we believe that the mid-cap space is the space to stay on if you believe that you can hold the market, your portfolio for more than 1 year. It's a great space to be in. We believe, so the names that you talked about were more pharma and finance, but even in consumers, I think there is a big leg up, and we are of the camp that we believe that GST will be implemented, will be passed, and that should have a meaningful benefit to many of the mid-cap segment names going forward.
Okay. Okay. Nitin, just to continue with the point that Sonia was making, we've nevertheless seen a fairly relentless selling from the FIIs. This month is the third largest in terms of month-wise sales by the FIIs. Do you think that will recede? I mean, 2,500 crores a day is some amount.
Yeah. So clearly, this is not driven by events in India. This is driven by what is happening globally. So emerging market funds are feeling the big pain of currency movements at this point of time. And the currency movements are very large in the last couple of months. So clearly, we are seeing that pressure. I think some pressure may come off post yesterday's discussions in the US that the Fed rate hike in September may be postponed to December. I don't know whether the world is still ready for a December hike also. So there is a possibility that some of these pressures on currency may recede, given that the US is possibly looking to postpone its interest rate increase. But yes, the FI selling in India was a key overweight in many portfolios. So it gets a disproportionate leg down if there is emerging market weakness in totality. So I think from that perspective, the FI selling may continue a bit more. I don't rule that out. Fortunately for us, we haven't seen much outflows at this point of time. In fact, on the contrary, we are seeing a little bit of inflows in our funds. So I don't know where this will end, but clearly this is the right time to be in the market. On valuation today, when you look at valuation on a 1 year forward, India is trading at around 15 times. On FY 17, which is March 17 numbers, India is not at 14 times earnings multiple. So at 1 year forward, 15 times, you're actually lower than your last 5-year PE multiple. And with the macro looking so good, in fact, to put, macro is looking beautiful, except for policy. So in that sense, it is a valuation at 15 times PE multiple is very attractive. But yes, there are events globally which overshadow the good macro or valuation at this point in time in India. Okay. So I think one has to take a view or slightly longer term and stay the course.
Okay, that point is taken. Just finally, before we let you go, you have the biggest allocation to banks in your fund, 29% allocation, and now we've seen some very good opportunities. So ICICI Bank has corrected from 380 to 280. Axis Bank has corrected from 600 to 500. Is this a good time to be increasing your exposure to the private sector banks?
I think fairly exposed there. We continue to hold our positions. What we have done very recently is increase our allocation to state-owned banks. This is one big change that has gone unnoticed, and that's a good thing, in many ways, that PSU banks, the 7-step program from Indradhanush, has been finally come into play. We have a CEO of a bank who is from a private sector. Imagine 2-3 years back, such an event would have been accompanied by a banking system getting paralyzed. And today that event has gone almost unnoticed. Yep. So it's a big change. It's a path-breaking change in our view. So we have increased our allocation to state-owned banks a bit. We continue to hold our position in private banks. We may or may not look to increase allocations, but if the relative opportunity just throw up, we will add to it. But as of now, we are happy with our exposure. And clearly, the big change from a policy perspective is in play. We are hopeful that credit growth will pick up. And asset quality issues are possibly the worst is behind us. We know it's not an easy game on asset quality, but I think the worst is behind us. So we are hopeful in that segment, and we remain constructive on banks as a whole.
All right, Nitin, it's a pleasure hearing you out. Thank you very much for your perspective and for your views on individual sectors as well. Okay, so that's